January is typically a quieter time of year, especially in the real estate business. You don't think as many houses are being bought and sold. It's a very busy time for us because of refinance and renewal. There's still purchases happening. Don't get me wrong. That's still happening every day. But it's a very busy time for refinance. And in our first segment, we really said that one of the big goals that Canadians have as a New Year's resolution is around financial health and wellness. We're going to talk, about what a refinance looks like.
Okay, and of course the political moves and changes to the law. What can you tell us? What's the latest?
There's been a lot of changes to the mortgage rules. Some that happened in December and some that are happening here in the middle of January. So in December, and this is big news, and I think it's for anyone buying a home, I think it's really important to understand this. Any first-time home buyer, when they're buying a home, can now get a high ratio insured mortgage. So that's from, the Canadian Mortgage and Housing Corporation, Sagen, or Canada Guarantee, with an amortization up to 30 years, as well as any borrower, new or existing, that's buying a new construction property, they can get a high ratio insured mortgage up to a 30-year amortization. The other thing that you're going to want to know is the limit for a high ratio insured mortgage used to be $999,000 and now has been increased to $1.5 million.
Okay, so tangibly, is this making a difference in business and in people in getting into products that they would otherwise not have?
The 30-year amortization is making a difference. For us, we don't have that many borrowers that are buying at $1.5 million that are putting down less than 20%. I think that's quite rare, but I think that's going to have an impact in larger markets like a Toronto or Vancouver. I think that's really going to help first-time home buyers, but I'm excited about the 30-year am. And, I get excited about mortgage lending. I think it's kind of fun. Obviously, we like talking about it, and hopefully our listeners like hearing about it too. But it will make a big difference for first-time home buyers. They will be able to qualify for a larger mortgage. And typically, first-time home buyers are usually younger people. So 30 years, I'm not that concerned about it. And most borrowers that take a 30-year amortization paid off in 25, 20, or less. Usually, borrowers pay their mortgages off shorter than the initial amortization that they take. The other big rule change that's coming into effect here in the middle of January is high ratio insured refinances up to 95% or 90% are coming back. So you can refinance your home up to 90% of the value.
It was 80, right?
Was 80, and it always had to be conventional. So now it will be insured by the Canadian Mortgage and Housing Corporation or one of the other insurers. But the purpose needs to be to add a secondary unit.
I see.
So it's very, very specific. The constraints, but it's a step in the right direction. And it's really, I think, a move from the federal government to help motivate
housing stock,
which we need. Which we need.
All right, but it's quite complex, is it not, to add a unit? You've got the municipality. There are all kinds of rules. There's zoning. That you're dealing with contractors. It's not for the faint of heart, though, right?
It is not for the faint of heart. And it takes a lot of money. So this 90% refinance, I'm excited about it. But I think you need to go in with your eyes wide open on what the cost is going to be to add that additional unit. I think it's great. I can really see it working for, maybe aging parents, maybe, finding, getting a housing unit for your offspring or maybe another family member. I can see that working really well. There's a lot of good reasons why someone would want to add a secondary suite. And in Atlantic Canada, we don't have a lot of finished basements. A lot of our properties have been built kind of above grade. So a lot of people have unfinished basements. So I think there's opportunity there. And I think even if people did have a finished basement, doing that refinance to be able to make it into a secondary suite, there are some things that you need to do.
And there are other financial incentives, I do believe. I'm kind of winging it here, but I think the province is offering some money, I do believe.
Okay, I'm not sure.
But I guess the point is do your homework.
Yeah, definitely do your homework. And it's something we're going to talk more about throughout this year. We need to get this program launched. It's not even launched yet. I can't even tell you the constraints or what the really the program looks like. We're going to know more after January 15th. Maybe we'll bring our one of our friends from Sagen in again on the show, and then we'll have more information for our listeners at that time. But this is something certainly to stay tuned to, and we certainly have a lot of borrowers already reaching out to us wanting to add secondary suites and wanting to take advantage of that program. So I think it'll be huge.
Okay, so when you're renewing, your mortgage renews, is that a good time? That's probably the optimal time if you're going to amortize and refinance. That's probably the best time to do it, is it not?
I think the best time to do a refi is at renewal. It's not always the time that people do it, though, Todd.
Yeah.
You know, I think the best time to refinance is the best time for
when you need it.
And everybody's situation is different.
Yeah.
And I'm going to talk a little bit about the mechanics of a refi. Yeah. You can refinance conventionally up to 80% of the market value of your home.
Yeah.
Okay. The reasons that somebody may refinance is to consolidate, consumer debt. Yeah. Maybe they want to refinance to pull out some equity to buy a secondary property or a rental property.
Put a roof on the house.
Maybe do some improvements to the property. Yeah. Exactly. And the other reason is maybe for investment purposes. Yeah. So there's a wide range of reasons why people refinance. And I think one of the reasons that we really don't talk about that much is sometimes people refinance just to extend the amortization to bring down their borrowing cost. That's a really big one right now, especially with consumers that are coming up for renewal. When we talk about this renewal cliff, I'm not sure it's going to happen, but 60% of Canadians have their mortgage coming up for renewal this year and next year. And those Canadians are having it typically, if they had a fixed rate and interest rate that's lower than where the rates are today. Yes, I do believe the rates are going to go down. Who knows what's going to happen in the U.S. and how that's going to impact us. And we need to remember that the fixed rates are tied to the bond market, and the bond market has been, really increasing lately. Yeah. And the one thing that I'm really watching is the Bank of Canada. Yeah. We had more decreases last year than we thought that we were, but I think we're going to still see some further decreases this year. Our economy is not strong in Canada. The GDP is low. I'm watching the Canadian dollar, and I'm confident that we're going to see some more cuts from the Bank of Canada. I think they want to spur some spending from Canadians, and they want businesses to borrow and they want consumers to borrow, even though consumers are at really all-time highs of consumer debt.
What about employment in general? I mean, obviously people look, if you're up for renewal and you want to refinance, you need to consider your employment situation.
Employment's important.
Yeah, huge.
So, certainly
your credit situation as well, right?
Credit, employment is very important. Obviously, the assets are important. The value of the property is important. All of these things come into play.
Yeah.
And I think when we're thinking about a refinance, it's 80% of the market value. Mm-hmm. The market value is what you could sell that home for. So, for example, if the market value of the property is $500,000, which is a pretty average home here in Halifax, you can do total financing of $400,000. $400,000 then would need to pay out your existing mortgage or any other secured debts like a home equity line of credit. And the remainder is the amount that you're going to be able to use for either those consolidated debt payouts, renovations, investments, or buying another property. And I think sometimes people have a confusion of how a refinance works. You can't just refinance to infinity because it's the home is the bank's security. And they need to know that if something goes wrong, that they are able to collect the money that they've lent you.
Yeah. I guess what I'm getting at is that if you're going to renew and you're in a good financial position, and conversely, if you're not, perhaps, then you may end up just having to take the renewal that is offered to you.
Yeah, sometimes you need to renew with your existing lender.
Right.
The one thing that I need to urge everyone is oftentimes the existing lender, they're like the cell phone companies.
Yeah, they'll jack it up high.
Not even jack it up. They're not going to give the best deal to an existing.
Right. Exactly.
Why would they?
Yeah.
Because they have you.
Yeah. I guess what I'm getting at is that if you can avoid that and you're going to have to get your taxes and your income and your notice of assessments and all that jazz, then make it worthwhile if you're going to go through that and get your best rate.
Yeah, you want to get the best deal.
Right.
And I think that's where it's so important. I see so many consumers that kind of come and see me kind of after the fact, or they're doing another transaction like, I renewed a year ago.
Yeah.
I messed up, whatever. And they just took what they were given.
Mm-hmm. Yeah.
And it was really, they didn't have any advice. They just took a 5-year fixed, and they're going to have a hefty penalty to get out of that term.
Yeah.
Because if you break a fixed rate early, you're either going to pay an interest rate differential or 3 months interest, which is ever higher. And you know what? The bank is like the casino. They don't lose. If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.